Hi there. So let's make a start. A big hello, a big friendly hello, and a warm welcome to today's session on the UK Outlook UK Autumn Budget. My name is David Kelly. I'm the Executive Director here at the British Chamber of Commerce in Singapore. Firstly, a huge thank you to our event partners, Select Investors, for supporting this important topic today. Select Investors are big supporters of the Chamber, so thank you very much for your continued support. This event is brought to you by them in partnership with them as well. So just a quick introduction to the event today. After some speculation that the autumn budget might have been shelved this year, Rishi Sunak, the Chancellor of the Exchequer, did deliver his autumn budget on the 27th of October. There are questions around how to generate tax efficient incomes in the UK, and that has become more pertinent in the light of the recent announcements of a rise in dividend tax rates from 6th of April 2022. And our panel will discuss how the budget impacts those looking to relocate to the UK, either for work or for retirement. But also wrapped up in today's session, we'll be discussing the Chancellor's presentation, and we'll explain the economic backdrop to this, major forecasts and spending commitments, relevant tax changes. We'll discuss how the budget impacts us here in Singapore, and more broadly, as I've mentioned, how the budget will impact those relocating to the UK. This is meant to be an interactive session, so please do post your questions to our panelists using the Q&A function. You can post those throughout the session, and I will try and answer those with our panelists towards the end. So a quick introduction to our speakers. We've got two brilliant speakers who are incredibly well known to the Chamber. So in no particular order, I'm really pleased to welcome Anil Scott, who is an associate partner at St James's Place Wealth Management. And Anil will take us through some of those economic outlook and market commentary pieces. And also Martin Rimmer, Head of International Tax at Select Investors, who will provide an outline of the main tax measures for us today. So a very warm welcome to you both. Really looking forward to this session. Thanks so much for your time. And Martin, I'll hand it straight over to you.
David, thank you very much indeed, and a very warm welcome from me to all our viewers today. Let me just start by sharing my screen and get the presentation on the go. There we go. Right, hopefully everyone can see that now. So a very, very warm welcome. My name is Martin Rimmer, Head of Tax at Select Investors, and I'm delighted to be joined today by Anil Scott, who's one of the financial advisors at Select Investors within St James's Place. As we get going, just obviously need to just share our brief disclaimer. Obviously, everything we're going to talk about today is correct at the point of discussion. The information is new, obviously, because it relates to an announcement just a couple of weeks ago. We will be discussing how some of this will affect us here in Singapore, but also particularly in the case of a relocation to the UK. So if anything comes out of our conversation today that you'd like a personal consultation on, please don't hesitate to get in touch. And obviously, please don't take the information we're sharing today as a personal recommendation. We need to discuss and apply it. So the budget itself, of course, is more than just about tax. Now, I know everyone has joined us just to hear the tax part. Actually, it's probably not true, is it? But no, a budget is so much more than just tax. So I've asked Anil to take us through the first part of the presentation, just giving an economic outlook and a commentary on the market. A budget is also about spending commitments. It's also about economic analysis. And when he's finished his presentation, which will take 15 to 20 minutes, then I will cover the main tax measures before we hand back to David to moderate that Q&A session. So without further ado, I'd be delighted to invite Anil to come and join us now. And Anil, over to you, my friend.
Thank you very much, Martin. Thank you, David, and thank you also to the British Chamber for hosting this Select Investors webinar. By way of introduction, I'd like to look at the background behind this budget, behind this spending review, because a budget, as Martin correctly says, doesn't sit in isolation. It has a wider social and economic context. There is this budget's been delivered at in the middle of, one would argue, a public health emergency that has had a monumental effect on public spending. There is, I would argue, an eye-watering public debt picture, which both present and future generations of Britons will have to manage. And led into this, of course, is a global supply chain strain, which we're seeing the effects of at the moment, exacerbated by Britain's departure from the world's second biggest trading bloc. So it doesn't, the budget doesn't exist in isolation. And just changing the slides here, I hope. Here we go. The response, the budget is in part a big response to the COVID-19 emergency. Now, I will argue that the boom years of the early 2000s and the feel-good factor of the Blair era are well and truly behind us. What I call the twin king hits that era has undergone over the recent past is the 2008 financial crisis, and of course the COVID-19 pandemic, which has left an environment of uncertainty over the UK's economic future. And it's important to remember that as we think about the spending pledges that are made in this budget. Today, there are as many question marks as there have ever been before over our collective prosperity. And finally, I'll look at the question of tax, which is really what this afternoon's webinar is all about. And I'll conclude by looking at the role that tax has played in the post-war period in the United Kingdom, the areas of potential opportunity for expatriates as they may seek to build on the advantages of being offshore, securing and consolidating those advantages as they look to possibly return to the UK at some point in the future. So we are ending on a note of optimism. Now, as I said, this budget has been delivered in the middle of a health emergency. UK GDP has declined by just under 10% in 2020, and this was the biggest drop for about 300 years. I think you have to go back to the beginning of the 18th century to see a bigger drop in output, in economic output in the country. Consumers and businesses adapted strongly. Britons are resilient, and the early summer of this year led to a rebound, an economic rebound, which was really just 2% lower than before the pandemic began. Of course, growth has slowed because of the spread of the Delta variant, disruption of supply chains, and the knock-on effect on goods and services. Now, in addition to this will make British consumers, very, very cautious. But we should also remember that the furlough scheme has essentially ended. It was started to be tapered by the Chancellor in September, and there has to be implications for economic growth. Economies are essential. Our economy is essentially a consumption economy. So what people do and what people spend on is vital. Continuing with the impact of COVID-19 and its effect on the budget, I think it's fair to say that there is still a great deal of uncertainty over the economic outlook in the UK, and of course how strong and sustained the recovery will be. Politicians probably won't tell you that. They're paid to be glass half full and very positive, and that's what we want them to do. We want them to lead us from the front, but it's worth thinking around the corners of this budget and looking at the wider implications of what's going on. And I think this point is crucial as Martin takes us through what the spending outlook is. There is a great deal of uncertainty over what the economic future will be. So let's look at some of the numbers. I don't want to bore you with statistics, but this is what happened. 2020. That dot there, just by where my cursor is what happened when we all went into lockdown around about April, March of last year. And you can see that certainly for the post-war period of British economic history, there hasn't been a as big, as steep a drop in output. You have to go back all the way, as I said, to 1709 to, and the historians amongst you probably know what happened there. I'm not sure, but it was 300 years ago when we had something worse than this. So this is serious. As I said, Britons are resilient. The government, correctly in my view, embraced the need to get back to work in one form or another, and I think they're probably on the money here, and governments around the world, however conservative they're being in response to COVID-19, realize that you can't run an economy and you can't drive prosperity from the spare room. And as we can see here, the return to work that reached its zenith around about July of this year led to a dip of just 2% below our output as a country before the pandemic began. Now, what about the effect on public finances, the impact of this health emergency on public finances? The middle point here, I think, is staggering. COVID is costing the UK government £340 billion right now and into next year. And for the purposes of this webinar, ladies and gentlemen, it's that relationship between support to households and businesses falling, being taken away, and tax receipts growing, that we need to watch. Because what's happening is the government is taking the slack off their support for people, businesses, and families going through this health emergency, and the burden is going to have to fall on something else, and that's usually the tax take. Now, I don't want to emphasize too much the negative aspects of this, but we've got to face it. 2020 to 2021, that is the effect of debt. The last time Britain faced this sort of debt burden was after World War II. And it's worth bearing in mind that we only finished paying off our debts, our loans, to take us through that conflict in 2006. So this is a problem for the future, whatever way you cut it, and however positive you're going to be about economic prosperity in the years ahead. There is a fairly significant debt burden that we and governments that we elect will have to face. Now, new things, I would argue that new things matter, and those of you who are in the UK at the moment or have been to the UK recently will probably agree with me when I say it's no longer fashionable to be wealthy or to have aspirations to be wealthy as it once was, and there's a reason for that. There is a very valid reason for that, and that again is down to the impact of COVID-19. COVID has not been felt uniformly across society. The pandemic has exacerbated structural and social inequalities with negative health outcomes for those already disadvantaged. COVID-19 may have, and some people would argue definitively has, had unequal effects depending on where you live in the UK, your level of education, and your socioeconomic and wealth status. This has put a lens very firmly on wider issues around the national economy, educational infrastructure, and of course the social security system. We have to bear this in mind. So the game has definitively changed, and the government and the people of the UK have new priorities, and these are some of the main ones, and it's worth going through each one of these really just to let it sink in on what the to-do list now involves. There needs to be a national capacity to respond to changing circumstances in emergencies like this, and that means strengthening local communities. It's evident from this pandemic that trust in local government has been palpably stronger than trust in the national government. Geographical inequalities have widened, deficiencies in home and community care and the funding of this have been laid bare, and there is already a tax argument or a tax incentive in play to address this. There's of course renewed focus on mental health across society, and a corollary of all of this is that any increase in dependence on social security, on welfare, will likely see a strain in that already strained system to keep up with demand. And of course that it invariably feeds through into taxation. Now, the budget's address itself, it was billed rather positively by the Chancellor as a budget to revive the UK economy. But what exactly is it going to do, and what are those spending commitments? It's about levelling up. We've heard a lot of that in the news. Taxpayers' money will be spent where it will make most difference on people's lives. That is, of course, creating a high wage and high skilled economy. If you're going to turn off the immigration tap and upskill, you have to do that, and that means spending money. The NHS, always a big hole, if you like, for public spending, is now crying out for more money, and that can't be ignored. Departmental spending, that's all the different departments that run government, the civil service, in other words, is getting a bigger spend than in any time of the parliaments of this century. So from 2000 onwards, there is more money going into government departments than there has ever been before. This is a big spend situation that we're looking at now and into the future. Now, Spending Review 21, which is what it is called, confirms the government's commitment to spending on the NHS, education, and an ambitious drive to turn Generation Rent into Generation Buy through 24 billion, the confirmation of a 24 billion sterling multi-year settlement for housing. Now, for those of you, and there are probably quite a lot of you who have investment properties in the UK or residential properties in the UK, you will have noticed over the last few years things such as capital gains tax coming into property ownership, erosion of various reliefs in recent years, and that's probably not going to change in the years ahead, because there are new priorities for the nation, and that is this broader imperative of levelling up and reducing the structural imbalances in the economy. So would we see more of that? It is very possible. This is really what it's all about. It's not about creating wealth for already affluent and wealthy people, the mantra of the Thatcher years. It's about creating a high wage, high skilled, high productivity economy with significant investment in infrastructure, growth and skills. That's a map of the Northern Powerhouse. Many of you may recognize that part of the United Kingdom. That's the infrastructure map of the Northern Powerhouse, and it's worth noting, to use this World War II analogy. It's worth noting that, like at the end of World War II, when the government was indebted to the sailors and airmen and soldiers coming back, having fought a conflict on behalf of their country, there is, I think, in this administration a real emphasis on people and voters who have put them in power from parts of the country that otherwise would not normally be voting for the party, the current incumbent party. So continuing with the COVID response, the big ones here, R&D is going to get a massive focus. 35 billion of rail infrastructure development in the United Kingdom over the next 3 years, taking the prosperity away from the prosperous southeast and southwest and moving it north to West Yorkshire, Greater Manchester, Liverpool, and the Tees Valley, spending on skills and to help the less well off, a goal never far from the aims of the current government, an increase in the national living wage and a freeze on fuel and alcohol duty. And I'm not too sure about the sagacity of the last one, but it is happening. So to conclude on the budget, I think there are 3 points worth making here. There is a shared prosperity that haven't already been made. There's a shared prosperity fund. This is part of that need to help to give opportunity to places of need. We have seen recently with the COP26, there is an ambitious commitment to achieving climate goals on the part of the United Kingdom, and of course this budget is doing the heavy lifting there. It's axiomatic that this isn't just a budget for England, it's very much a budget for the Union, and there are specific incentives and directives to the various parts of the Union and their regional concerns. Now, just to conclude, and I'm getting near to the end, just to conclude, I thought it would be useful. I've alluded to it already to try and make a comparison between what's happening now and what Clement Attlee's government at the end of the Second World War, the new Labour administration, faced at that time. There was arguably a similar predicament, hard choices about how to raise taxes to fund a significant deficit. Clement Attlee and the Labour government looked at death duty, and I'm sure Martin will expand on this. You'll probably be relieved to know that that at present nothing changes with regards to inheritance tax. I would argue it would be wise, however, for investors to look at allowances and exemptions while they are available. That's the key phrase, because there is no certainty on this. In fact, the evidence in terms of raising taxes quickly means that income tax, national insurance, and VAT usually do the heavy lifting, and we're already seeing that. But don't rule anything out for other forms of tax. This is a graph that shows you how the UK government have essentially dipped into the bounty that is inheritance tax. It hasn't changed since the middle of the 1980s, which is good news, but it is a tax on the wealthy. So I think it's worth keeping a watching brief, as the lawyers say, on that one. Now, in conclusion, I'm coming up to the end of this section of the presentation. I think the arc of prosperity, the continuous arc of prosperity that, broadly speaking, was ushered in by Mrs. Thatcher's seminal election victory in 1987 and lasted, with some interruptions through the early 2000s into the exuberant Blair years, was shaken badly by the financial crisis in 2008, and we all remember that. The debt burden from this was still very much on the balance sheet when the shock of the COVID-19 emergency arrived. What this points to is that the game has changed. It's definitively changed. Public finances and new government spending imperatives are there to ensure now prosperity and cohesion of us as a nation, of Great Britain as a whole. And that means policymakers are arguably facing their biggest test in modern economic history. I do want to end on a positive note, however, and there's nothing like a picture of the City of London to end on a positive note. But I do want to end on a particularly pertinent note in this next slide. Fortunately, British expatriates, which I'm sure are many of you, still have a unique opportunity to benefit from a robust and attractive offshore investment environment, where the structuring of their financial affairs can be undertaken in a tax advantaged manner. Those benefits, of course, can be consolidated, secured, and seamlessly repatriated back to the UK. That's the repatriation process. And I would always argue that there is never a bad time to look at protecting and preserving your wealth, but probably particularly so in this current economic environment. And on that point, thank you very much for your time, ladies and gentlemen. I will hand over to Head of Tax from Select Investors, Martin Rimmer. Thank you very much.
Neil, thank you very much indeed. A very thoughtful summary of the background. I appreciated the history lessons embedded in there as well. That was really very good. Thank you. So it falls to me now, ladies and gentlemen, just to say a few words about what the budget actually did say about tax. Obviously, the budget is more than just about tax, and you'll be pleased to know, actually, there wasn't an awful lot in there, but there were one or two things just to mention. Now, I want to start by a quick refresh of the main personal tax implications coming out of the March 2021 budget, and that was simply this: that all of the income tax, capital gains tax and inheritance tax allowances, as well as pensions allowances, have been frozen up until at least the 6th of April 2026. You may or may not remember that if you joined the last presentation. So nothing will be changing in terms of allowances. Thresholds may change, tax levels may change, tax rates may change, but the allowances that you're entitled to will not, at least until the 6th of April 2026. Now this, Anil spoke a few moments ago about the very high levels of debt and the spending just on COVID alone between 300 and 400 billion pounds. These personal tax measures that they're keeping in place, just freezing those allowances, will raise just 21 billion pounds over that 5-year period. Corporation tax is also going to be going up from the 1st of April 2023 for businesses that have profits of at least £250,000. That will go from 19% to 25%, a very significant increase, and that will raise another 47. So you're looking at a total there of about almost 70 billion pounds raised by these main measures, as against a backdrop of GDP, of debt against GDP of over 100% soon. So I think the point I wanted to make in that there were really two conclusions. One is they've got to do an enormous amount more to get that debt down. How are they going to do that? I think they're going to try to grow their way out of the problem, possibly inflate their way out of the problem. And yes, tax policy will certainly have something to do with it as well, as we can expect. But secondly, Rishi Sunak has given us all the impression, he actually used these words in the March 2021 budget, that repaying the national debt, particularly the COVID element of it, is a generational task. In other words, it looks to me as though the government's going to be treating this effectively as war debt, repayable over the very long term, which in turn means that they don't need to do any drastic overhauls of the tax system. I mean, they might, but we've seen no evidence of that so far. Change is inevitable in tax. There will be changes, but we're seeing no knee-jerk reactions, which has been quite surprising given that 12 months ago, there was rampant and very well-founded speculation about the introduction of a wealth tax, about some major changes to the inheritance tax regime, speaking into a point that Anil just raised, potentially aligning the rates of capital gains tax with income tax. We haven't seen that. And this last budget, I would describe it in tax terms as a bit more tinkering around the edges. So let me just show you. These are the main announcements. So as far as corporation tax is concerned, following our withdrawal from the European Union, they've abolished certain reliefs for corporation tax purposes. So cross-border relief, where you've got groups of companies operating, in this case around the EU, where you could set losses from one against the other, that will be gone in April 2022. And they're also tinkering with some other loss release for corporation tax, which of course will help to bolster the tax take from companies. Perhaps amazingly, I think you all remember following the financial crisis that the UK government introduced a surcharge to corporation tax on banking profits. The banks were arguably the big winners of the financial crisis. So they had that, and it was at 8%. From the 1st of April 2023, that's going to drop from 8 to 3%. Bit of a surprise there, isn't it? And also the profit threshold at which the new reduced 3% rate will begin to apply from has risen from 25 million to 100 million. So a tax cut for banks. In the last couple of budgets ago, actually in the last budget, forgive me, in March, the government introduced or promised to introduce a new tax on large-scale residential property developers, Western Homes, Berkeley Homes, people like that. And they've now announced a little bit more detail on that. It's going to be a 4% surcharge on the profits made by those companies where profits are more than £25 million, and that in turn will come into effect on the 1st of April 2022. The 1st of April is the start of the company tax year. The 6th of April is the start of the UK, the personal tax year. And in fact, they're consulting on aligning those two things as well, which I think would make quite a lot of sense. Just a few other things that they've announced is that they are going to consult on introducing some form of an online sales tax. So in other words, if you're in the UK and you're buying things online, there would be some, from a non-UK domiciled entity, there would be some kind of tax on that, either at the point of purchase or on the profits from those entities. Quite a difficult one for them to crack, actually. And they're also going to be introducing a regime by which companies can elect, foreign companies can elect to change their place of historical incorporation to the UK, which would allow them, just by virtue of paperwork, rather than meeting any other conditions, to sit within the UK corporation tax regime, which, you know, at the moment is 19%, will rise to 25% for businesses with profits of more than £250,000, but it's still a very competitive corporation tax rate. And I think it's a very good forward-looking measure. It will be bringing the UK in line with many other countries. And then in every budget, they're always doing more to tackle egregious tax avoidance. So the types of tax planning we talk about at Select Investors and St James's Place, very mainstream, vanilla, no problems, but there's a whole industry of very aggressive tax avoidance, which the government's very keen to clamp down on. Now, tax avoidance is not illegal, tax evasion is, but avoidance is aggressive where it seeks to use the law in the way that legislators didn't envisage. Or if it exploits loopholes in the law or things that aren't in the law that could be, in order to create an artificial tax advantage. And they're really clamping down on that very hard. Now, in terms of personal tax measures, this is really relevant to a number of us. So capital gains taxes, you may be aware, whenever you sell, give or assign an interest in any form of directly or indirectly held interests in UK land and property, you have to make a disclosure under what's known as the Property Disposal Service and pay tax. And that has to be done online. And it had to be done within 30 days of the completion of the transaction. But for all completions from the 27th of October budget day, that's now extended to 60 days. 30 days was a tight deadline. 60 is much more manageable. So that's good news. So if you're selling or giving away property or any interest in UK land and property, whether held directly or indirectly through a company shares, etc., then you have 30 additional days. Now, where there is a law presently that says that occupational pension schemes can only be accessed by those of us who are not in serious ill health from the age of 55. That will be pushed out to the age of 57 with effect from the 6th of April 2028. Third point, and this is going to be of importance to anyone who's looking to go back to the UK and perhaps become self-employed. So often people go back and then they might play golf for a few months, but actually do like to stay in professional life and do that as self-employed. We have a really weird way of taxing or deciding what profits should be taxed in what tax year. And we also have this crazy thing called overlap relief and overlap profits, which is just insane. So what they're trying to do now is they're going to be requiring people to account for their profits and losses based on what actually happened in the tax year. Wow, that's such a simple thing to do, isn't it? But we've never been doing it like that. That will come in from the 6th of April 2024 to coincide with the rollout to landlords, both resident and non-resident and self-employed, of something called Making Tax Digital. Now, George Osborne, the former Chancellor of the Exchequer, stood up and announced exuberantly in I think it was the autumn 2015 budget, that he was going to do away with the annual tax return. And this is what that is about. It's taken a long time to get here, but it is an object lesson in needless complication. They will indeed do away with the annual tax return with effect for the tax year starting on the 6th of April 2024, but they are replacing it by, if you're a landlord, there will be a requirement to make a quarterly submission. And then at the end of the year, when you've done 4 quarterly submissions, to do a reconciliation submission of that income from rental properties. And then there will be a need to disclose other things in a 6th submission at the end of the tax year in respect to things like residence and other sources of income. And those quarterly submissions need to be made per property. So if you have 2 properties, that's 8 quarterly submissions. So you can it's just insane, but it's coming, and we gradually need to get ourselves prepared for that. So totally needless change, in my humble opinion. It's just going to make everyone's lives a little bit more complicated, but it will mean that that it's likely that more likely, I would suggest, that it's wise to appoint a tax professional to actually look after those submissions for you. Now, I also just wanted to highlight something that wasn't in the budget but was announced in August, namely a rise of 1.25% on the main rates of dividends. So dividends arising from shares and some types of unit funds. This is a rise in tax if you are UK resident on global dividends, and if you're a non-UK resident, just on UK dividends. Now, you have a dividend allowance of 2,000, they're not touching that, but those rates, as you can see, are going to be going up by 1.25%. So this is bad news for investors in shares and funds, but I'll come on to in a moment why that's still a terrific asset class. But also it's a tax on owner-managed businesses, which like to pay out dividends to their shareholders or indeed to themselves. So you can see there under examples, if you have a £20,000 dividend, the current tax take £407, it will go up to 425, and you can see there for the different levels of dividend payments how the tax rise is a little bit basically see what the differences are. So that's coming down from the 6th of April 2022. And also, oh yes, let's just do the comparison. So what we have here though is we have four different types of income and gains. So we have dividends, other income, so anything else, capital gains on investments, and capital gains on residential property gains. And you can see that we have a basic rate of tax, a higher rate of tax, and then additional rates of tax. And the tax rates are different. So in fact, we have 12 rates of income and capital gains tax in the UK, would you believe? You will know and probably be very familiar with the 20, 40 and 45 ones. But if you think about the different types of incomes and gains and what the lowest tax rates are in the basic, the higher and the additional higher rate band, dividends still offer the best value for money at just 8.75% from the 6th of April 2022. And capital gains from investments, i.e. potentially from the sale of dividend-bearing investments, are just at 20%. So we would tend to suggest as an important part of an investment strategy, particularly upon relocation to the UK, that dividend-bearing investments, shares in companies, units and funds held directly should be a very important plank of that, as well as taking advantage of things like ISAs and pension savings. Non-residential property gains, as I say, shares gains from the sale and alienation of rights in shares and funds. We don't want you to be a higher rate taxpayer because that jump at dividends from 8.75 to 33.75 is big. The jump on other incomes from 20 to 40 is big. I guess the jump in capital gains from 10 to 20 is tolerable. So we would always be recommending that, to the extent that you're in danger of being higher rate taxpayers, that additional capital is held in what's known as an international investment account, which carries some terrific tax advantages. And we cover this on our repatriation relation to the UK webinar. But the point about an international investment account is that the longer you have it as a non-resident, the more tax efficient it is when you eventually get back to the UK, even if you only start it with a small amount. Start it early. So just one more thing to say before we get going with the Q&A. At the same time we introduced the dividend levy, they announced a new tax called the Health and Social Care Levy. Now this will be introduced from the 6th of April 2023 at a discrete rate of 1.25%, and it'll be collected alongside tax and national insurance. And it is a tax on taxable professional earnings, so employment income and self-employment profits. Now, most of us out here are not even going to be touched by national insurance, but when we get back to the UK, we certainly would be. It's going to be collected as a surcharge to national insurance. Between from the 6th of April 2022 until the introduction of the Health and Social Care Levy, there will be an increase in the national insurance rate by 1.25%, and that will then be reduced at the end of the next tax year to make way for the introduction of the Health and Social Care Levy as a discrete standalone additional levy. And the thing is, with a new tax, they can change the rates, they can change the threshold. So that will be here to stay. That is ostensibly set aside to fund the NHS. And as I said, voluntary national insurance contributions, which many of us pay, are unaffected by that. So look, you can see the effect there just by glancing down what those rates are for employees. It goes up to 13.25%, and on the excess above the main rate, it goes to 3.25%. For an employer, well, basically 15.05%, whereas at the moment it's 13.8%. I won't talk you through the differences, but the point is it is a levy. You will end up paying more if you go back to the UK, have employment income or self-employment income. So just a couple of closing words before we hand back for Q&A. The government has entirely unaddressed some very important Office of Tax Simplification recommendations for the recasting of the capital gains tax and inheritance tax system. I think that probably will come, but because we think that the government is treating the national debt as a generational task and therefore doesn't need to make knee-jerk reactions and do radical overhauls of the tax system, we think that means you can plan with greater confidence for both inheritance tax purposes and capital gains tax purposes. Change will inevitably come, but we don't think it's going to come in a big sweeping statement. We think it's more going to be the gradual piecemeal introduction of changes. So, so this budget in tax terms was merely tinkering around the edges. I'm sure we will see greater change in future budgets, but hopefully this brings you all up to speed with the main changes that we have seen here. So in conjunction with Anil, your excellent commentary and this update on tax, hopefully this gives you the answers or the information that you seek. So what I'm going to do is stop the share now so that we can get on with some Q&A, and I'm delighted to welcome David back to host that for us.
Thank you so much, Martin. Thanks, Anil. Really great high-level session. Both of you, really good. Just a reminder for everybody, we've got about 15 minutes. So this is your chance to ask questions on what's been presented today. I know we've got one in the Q&A box, but I've got a couple that have come through previously for this session, just to get things going. But please do put your Q&A through. Martin, I guess if I could sort of start with you. Anil had said about the staggering level of government debt and what you had said about the task of repaying it being a generational one. You mentioned that right at the end as well. Surely there have to be some tax rises at some point in the future, right? I mean, I know you don't have a crystal ball, but what do you expect these to be and when? I mean, when can you start seeing those sort of being factored in over the next number of years?
Yeah, good question, David. The tax profession has been really surprised by the absence of changes to capital gains tax and inheritance tax. You know, the Office of Tax Simplification, that's a very poorly named body, by the way. It never simplifies things, always makes it more complicated. But they've made some pretty sweeping proposals for what, on the face of it, seem to be some sensible changes to inheritance tax and capital gains tax that the government has left entirely unaddressed. They just simply haven't interacted with it. I think they will. Corporation tax will go up in April 2023. The government always seems keen to spare private individuals from swinging tax rises, and of course both capital gains tax and inheritance tax are personal taxes. I would, I guess, expect to begin to see some change within perhaps a year or so of that. Have to balance that with political realities, of course, because there'll be a new election, I think, in 2024 or 5. So maybe it'll be a little bit later than that. You're not exactly going to ride out on the manifesto promise of staggering tax rises to repay COVID debt. You might ride out on prudence, as Gordon Brown did many years ago. So yeah, I'd be going 2 to 3 years. Perhaps we'll see something.
Okay, really interesting. I'm going to ask you sort of another question, bring Anil back into this as well. And it's just there were a number of sort of elements of the budget that were coming into effect, you know, with sort of, you know, in 2 years' time. And you've mentioned the low tax on alcohol and the high tax on long haul flights, which will have an impact on business and people traveling, seeing themselves all over the world. But those longer term sort of commitments, is that because the UK is still dealing with the pandemic? Is it because there's a lot happening around the levelling up agenda that's been mentioned in both presentations? Is it the COP26 discussion we've been having? Is it, as you've mentioned, the next general election? Is it because there's just so much going on at the moment that actually this needs to be a really considered approach over the next couple of years?
Anil, perhaps you could take that, and I'll come over the top with some thoughts.
Certainly, David. I think the answer to your question is it's all those things. It is an agenda of levelling up, which is a political, social agenda. It is addressing what are obvious structural imbalances in UK society which need addressing. They can't be put off. Because that's about social cohesion, and we've seen during an emergency you need social cohesion, particularly at local level, and it is of course about the environment. Having said that, as Martin rightly said, this is still, and I noticed there is a question in the chat. This is still nominally, this is still a Conservative administration. This is still a Tory government, and I don't think they can go too far on tax increases or possible restructuring of the taxation system too quickly. Apart from anything else, if you start doing that, you will drive away the wealth creators in the country. They'll you know, move offshore and set up homes in other parts of the world. So I think, you know, yes, there is a challenge to address, but I think Rishi Sunak and the Treasury will do it in a measured way, as Martin correctly says, and that's good from our point of view because it gives us time to plan.
Yeah, and I think just to add to those comments, Anil, yeah, I guess there's an analogy. If you're a bit overweight and portly and you want to become really healthy and fit, you've got to start by making sure that you're doing all the right things first, and dealing with structural issues within the economy, within society, environmentalism, levelling up. That surely has to be the first thing that the government addresses. And whilst they're doing that, they might seek to address some imbalances within the tax system. But of course, we have a very, very complicated tax system that has been designed with an element of fairness to it. So I can see why perhaps tax reform sits perhaps a little bit further back on the agenda. We need to fix the country, and then we can fix or address things within the tax system that need addressing. And to your point, Neil, it's obviously vitally important that we're not driving businesses and high net worth people out of the UK. Corporate redomiciliation, for example, is a move to try and get businesses in. So very well put in there, and I think you know, that may explain in part why we're not seeing huge amounts of messing with the tax system in recent budgets. Yeah,
and a bit of a build on that, Anil. I mean, you know, do you expect any of these challenges and opportunities to change substantially in the years ahead, if the government, you know, with the government in power changes? You know, again, so not asking you the crystal ball questions, that's obviously very, very difficult, but do you expect those challenges to substantially change?
I think challenges are and opportunities, because they're two sides of the same coin, exist regardless of the political hue of the government in power. So, David, for the near term, I very much expect that to remain in place, whoever's in power and whoever sits in Downing Street. In terms of how those challenges will be turned into opportunity, I think that really depends on the talent and caliber of whoever occupies the number 11 Downing Street and their team at the Treasury. I think in Rishi Sunak, you have a very, very capable finance minister, probably one of Europe's best at the moment, but his influence is somewhat limited by the circumstances that he finds himself in. What I do think, though, is that we won't be seeing any time in the next election cycle a government, wherever it comes from, promising small government and the ability to have ever decreasing taxes. I just don't think that's possible given the current imperatives of batting our way out of this health emergency. I think the challenges will be there. Whether they're turned into opportunities depends on the caliber of the people in charge.
Okay, no, very, very interesting. Anil, if I can stick with you as well, I think, and I hope this figure's right, it was the Office of Budgetary Responsibility. It said that inflation will reach 4% by the end of the year. I mean, that will have an impact on two things, I think, in terms of how far your money will go, but also sort of savings as well. How do you see sort of elements in this budget, or certainly your experience with your clients, sort of address what happens if the inflation level gets that high?
I think it's a very good question, and I'm sure Martin will be able to come in on this. I think there are three things to bear in mind on the inflation question. The inflation situation at the moment is a bottleneck, primarily driven by bottlenecks. What happened is that we all went into hibernation, and then we came out. And to use Martin's gym analogy, we came out rather overweight or needing to exercise, and we went straight back into the gym and started sprinting on the treadmill. And that has caused a massive build up in demand on the supply chain. Now that will dissipate over time. I don't think we're going to see 70s style stagflation or anything like that. And governments and policy makers, they're not really concerned about you and me, about white collar professionals who have share portfolios and investments. They're concerned about the ordinary man and woman in the street that put them into power. They're concerned about the living standards of ordinary people, and we're living in a populist environment around the world right now. In terms in my experience with my clients, I think that would be the same for any sensible investor. When you have an inflationary environment, you have to make sure that your assets are keeping pace with inflation and beating it. So it really just makes sense to cast a lens on that and make sure you're not doing anything that puts you in an inflation disadvantaged position. I'll pass over to Martin on this, but my feeling is that inflation blip won't be kind of months long. It might be a little bit longer, but it's not going to be a kind of long period of rubbish piling up in the streets. I just don't think that policymakers and central banks will let that happen.
Just a couple of things to add to that. I mean, very good response, Anil. Any threat to disposable income needs to be taken really seriously, or any threat to the real value of that disposable income. So, from the perspective of working within a wealth management business, there are three ways of addressing that. First way is to make sure that your investment strategy is sound and well thought through, properly managed, and of course we would commend St James's Place to anyone who needs that kind of a service. Secondly, the cost of investment needs to be kept under control. Fees and commissions need to be kept tight. Thirdly, most importantly, we need to structure those holdings in a way that carries greatest tax efficiency. Tax is a drain on income. It's a drain on disposable income, and you know, a lot can be done to keep someone very, very tax efficient, particularly with retirement income. So yeah, I just add that.
Thank you, Martin. I think we've got time for another couple of questions. Just keen to address the question that's come through. Anil, I know we've answered sort of some of that, but Rob does ask, sort of, he'd be interested to hear your views on education receiving significantly less attention in this budget than many suggest it should have. Certainly when you look at the other elements of the levelling up budget that's going in, I think there's sort of other elements of education spend across other bits and pieces as well. But I was personally surprised not to see more in the sustainability piece as well. Were there, looking at education and perhaps other bits of the budget, were there sort of other areas of the budget announcements that you felt were surprising?
So your question is did the commitments to education and other parts of the spending come out of the blue or surprising? Is that?
Yeah. So Rob's asking about sort of you know, he's interested to hear your views on education receiving less attention in the budget. But I think sort of widening that question as well. There are a couple of areas that I sort of felt personally I thought could have had a bit more focus. And I think sustainability personally was one of the ones that I sort of thought, yeah, that was. I wondered why. So I just wondered if you could, give your opinion on that.
Yeah, I have to be honest. I haven't crunched the numbers to see what relative education spend or relative environmental or relative sustainability spend is in this budget. But what can we deduce? So much has been laid bare by the pandemic itself, and one of the things that did come to light was youngsters with lack of with limited opportunities to high quality education, pedagogical infrastructure, suffered more during this pandemic than their peers. Now that's everything from not having access to broadband and a viable online learning platform from their schools, to being stuck at home in dysfunctional situations and not having a great learning environment. So like many things coming out of COVID-19, I think there are people in power who are thinking, look, we've got to address this. We can't let this form of structural imbalance go on. I suspect, David, that environment is probably, although it hasn't been mentioned heavily in the budget paper, I suspect it's getting a big focus in terms of spending. You can see through what Alex Sharma's doing and Boris Johnson getting behind him that the will is there. So I suspect the money will follow.
Oh, great stuff. Thank you. Thanks for addressing that, Anil. Martin, perhaps if I can just sort of turn the last question to you. And it's about filling that gap and about that sort of national debt being generational. I mean, expats might be seen as being easy targets in many respects, and I think many of us, well, we can't vote outside of the UK, and we can't sort of write to our MPs. Although I will hasten to add that the Chamber and the High Commission do work as closely as we can to represent your interests. But what is the likelihood, in your opinion, of the government introducing a global tax system on British expatriates like the US already has in place?
I get asked that question an awful lot. That's a really good one. I think it's highly unlikely. Just finish on a positive. Yeah. It works in the US because the US has got an IRS office in most major cities globally, and everyone in the US is required to file a tax return. Not every British person is required to file a tax return. There really isn't much of a register that the government has of where people are at. And I think the only offshore office that HMRC has, to my knowledge, is a tobacco office in KL. So there simply isn't the infrastructure, and it would be very difficult to implement as well. They don't have a proper record of okay, they could say you must register, fine. But then you've got double tax treaty relief that would counteract quite a lot of those tax advantages. You get credit for all the local tax paid. I think it would be extremely costly to put into place, and I think the last time it was even mentioned in Parliament was I think it was David Miliband. Who's he, Foreign Secretary at the time? I think, but 2008. It was one sentence. It just isn't being talked about. I just think there's zero political appetite for it.
Oh, that is good. That is good news for all of us. Thank you very, very much. Martin, Anil, thank you so much for your sharing today. That's been a really great session. If I may, if anybody has that moment of reflection after today's session, whereby you wish you hadn't answered a question, and perhaps I can put them through to Anil and Martin, and we can get those answered for those on the call, just in case somebody does have a question afterwards, and we can put you in touch. A huge thank you. That's been a really, really, really engaging session. Thank you so much. I think we might have a couple of events coming up. We're getting sort of edging closer towards Christmas. I think a lot of the community are also leaving, going home, seeing their families, reconnecting slightly earlier this year. But there are two I just want to highlight quickly here. One is our Leaders in Business Lunch, which I think is actually now sold out as of today, but this is a physical session with the British High Commissioner, so we're looking forward to that. And we have a BritCham Presents on Brexit and Where Are We Now, which is a really exciting webinar that we've got at the beginning of December as we close off towards the end of the year. So that leaves me to say a very final thank you to our speakers, to Martin and Anil. Thank you so much for your time, for joining us, for your sharing, for answering the questions. Thank you for joining us today, the audience, and thank you so much to Select Investors for your continued support of the Chamber as well. And with that, I bid you a very happy evening. Take care, everybody.